Welcome to our in-depth financial analysis of Arista Networks, ticker symbol ANET. Today, we'll be dissecting a crucial aspect of their financial health, working capital and liquidity. Arista Networks is a leading player in cloud networking solutions, and understanding how they manage their short-term assets and liabilities is vital for assessing their operational efficiency and solvency. This analysis is tailored for individuals and professionals seeking to make informed financial and business decisions, providing a comprehensive overview of ANET's ability to meet its short-term obligations and fund its day-to-day operations. Our goal is to uncover the insights that determine the company's financial stability and its capacity for sustained growth. Let's dive in.
Before we delve into Arista specifics, let's establish a clear understanding of working capital. Simply put, working capital is the difference between a company's current assets and its current liabilities. It's a critical metric that measures a company's short-term liquidity, its ability to cover its short-term debts and operational expenses. Negative working capital can signal potential liquidity problems. A healthy working capital position is crucial for funding daily operations, unexpected expenses, and seizing growth opportunities without relying on external financing. Now, let's look at the components that make up Arista Networks' current assets. These are assets expected to be converted into cash within 1 year. For ANET, key components typically include cash and cash equivalents, which reflect their immediate liquidity, accounts receivable, representing money owed to them by customers for goods or services delivered, and inventory, which includes products ready for sale. Understanding the proportion and trends within these categories provides insight into how efficiently ANET manages its resources and generates revenue. A strong composition of highly liquid assets is always a positive sign.
Moving on to the other side of the working capital equation, let's examine Arista Networks' current liabilities. These are obligations due within 1 year. For ANET, significant current liabilities often include accounts payable, which are amounts owed to suppliers, deferred revenue, representing payments received for goods or services not yet delivered, and accrued expenses, such as salaries or taxes that are incurred but not yet paid. Understanding these liabilities helps us gauge the company's short-term financial commitments and how they are managed in relation to its current assets. Efficient management of current liabilities is just as crucial as managing assets for maintaining the healthy working capital. Analyzing the trend of Arista Networks' working capital over several periods offers valuable insights into their financial management. A consistent increase in positive working capital typically signifies a growing capacity to fund operations and expansion. Conversely, a declining trend might warrant closer inspection into asset or liability management. For ANET, we generally observe a robust and often increasing working capital over time, reflecting efficient operations and strong financial discipline. This trend is crucial for investors as it indicates the company's sustained ability to navigate short-term financial cycles and invest in future growth. Beyond raw working capital figures, liquidity ratios provide a more standardized measure of financial health. The current ratio, calculated as current assets divided by current liabilities, is a fundamental indicator of a company's ability to pay off its short-term obligations using its short-term assets. An industry benchmark often sits around 2.0x, indicating a healthy buffer. For Arista Networks, we observe a robust current ratio, for instance at 2.5x, suggesting excellent short-term debt coverage. This means ANET possesses $2.5 in current assets for every dollar of current liabilities, providing significant financial flexibility and stability. The quick ratio, often called the acid test ratio, offers an even stricter measure of liquidity than the current ratio. It's calculated as cash plus marketable securities plus accounts receivable divided by current liabilities. The key difference is that it excludes inventory from current assets, as inventory can sometimes be difficult to convert into cash quickly. A typical industry benchmark for the quick ratio is 1.0x. For Arista Networks, a quick ratio such as 1.8x is highly impressive. This indicates that ANET can comfortably cover its immediate liabilities without relying on selling its inventory, signifying exceptional immediate solvency and financial resilience. Beyond static ratios, the cash conversion cycle, or CCC, provides a dynamic view of how efficiently a company manages its working capital to generate cash. The CCC measures the number of days it takes for a company to convert its investments in inventory and accounts receivable into cash, offset by the days it takes to pay its suppliers. The formula is days inventory outstanding plus days sales outstanding minus days payables outstanding. For Arista Networks, a CCC of, say, 45 days indicates highly efficient management of inventory, receivables, and payables. A shorter CCC is generally better, freeing up cash faster for reinvestment or other strategic uses, reflecting strong operational management.
In conclusion, our analysis reveals that Arista Networks demonstrates a remarkably strong working capital and liquidity position. Their consistently positive working capital, coupled with robust liquidity ratios, a current ratio of 2.5x and a quick ratio of 1.8x, underscore their financial stability and ability to meet short-term obligations comfortably. Furthermore, an efficient cash conversion cycle, exemplified by a 45-day CCC, highlights their operational excellence in managing cash flow. These factors paint a very positive outlook for ANET, suggesting not only resilience against market fluctuations, but also a solid foundation for continued growth, strategic investments, and enhanced investor confidence. Arista Networks appears well positioned to leverage its strong financial health for future success.